Last winter, Europe encountered impacts from substantial storage overhang, mild weather leading to subdued gas demand, and continued economic weakness. From Feb 24, prices embarked a significant recovery supported by strength in Asian demand and bullish supply-side factors such as LNG project delays, Arctic LNG 2 uncertainties, and Egypt switching to a net importer. Over the summer 24 period, the front seasonal UK gas and power contracts appreciated by 21% and 12% respectively. High price fluctuations are also observed in the LNG market, with front-month JKM prices appreciating by 60% since the lows of February due to tightening market fundamentals, coinciding with geopolitical risks and La Niña weather forecasts, which could lead to heightened volatility through this winter. The same price trend has also emerged in the European market, with month-ahead TTF gas prices gaining 70% since February, re-anchoring above the average coal switching price, meaning that gas-fired power stations would financially underperform against most coal-fired power stations in Europe over winter, driven by the prevailing coal and carbon price levels. This is simply due to expectations of higher residual demand compared to last winter and short-term marginal cost of gas and coal burn keeping at parity. Interestingly, British gas plants are at a slight cost disadvantage against Europe of €1 to €3 per megawatt hour over winter, which will keep the UK as a net importer from December to March 25. It will also be the first winter without British coal after decommissioning of the last plant at the end of September. From a broader perspective, global gas demand has returned to structural growth in 2024. Based on the first 3 quarters of this year, demand grew by 2.8% versus just 0.7% throughout 2023. Now, interestingly, 50% of this growth was mostly observed in the first quarter of 2024, which has slowed in the second and third quarter due to price-sensitive markets including Southeast Asia. In contrast, European demand increased by 3% in the first 3 quarters of 2024 due to low gas burn in the power sector. However, a growth rate of 11% winter-on-winter is expected, albeit below the 5-year average. In the first 3 quarters of this year, UK aggregate gas consumption was 5% below the same period in 2023. Whilst LDZ demand has increased by 4%, gas for power and industrial demand have decreased by 24% and 4% respectively, due to stronger renewable output and robust nuclear generation. UK power demand has grown by 0.4% so far year on year, and expected to increase by 3.1 terawatt hours winter on winter, based on average temperatures, with demand recovery structurally aided by ongoing electrification of transport, heat pumps, and new data centres. Tighter market fundamentals provided upward pressure on Asian and European prices in Q3 24, with JKM keeping a $1.6 per MMBTU premium over TTF prices that was driving flexible cargoes away from Europe. European LNG inflows fell by 20% year on year in Q1 to Q3 24 due to lower demand, high storages, and stronger piped gas flows from Norway and Russia. LNG arrivals into Europe are expected to be 3% lower this winter due to lower demand and potentially higher spot LNG procurement from Asia. However, global LNG exports have been very healthy this year and mostly kept above the levels observed in 2023. Interestingly, the amount of Russian LNG volumes into Europe have increased, which may come as a surprise. However, this is due to sanctions only targeting new Russian LNG projects, which in turn allow Europe to import existing LNG contracts. Moreover, a couple of months ago, the EU introduced a ban on transshipments of Russian LNG cargoes to third-party countries, which has also contributed to higher Russian LNG imports. Uncertainties coming from the demand side are significantly greater, with temperature fluctuations remaining a key driver for gas demand. We expect a partial demand rebound on the back of more normal winter temperatures, but with considerable weather-driven risk that is exaggerated by growing exposure to wind and solar load factors. So longer-range forecasts currently point to normal to mild conditions as an average over winter season, but with the risk of cold snaps developing from November to January. The NOAA currently states 60% chance of La Niña conditions developing before November. La Niña events can weaken the polar vortex, thus increasing the chance of sudden stratospheric warming events. SSWs can lead to cold snaps, but the duration and severity of cold snaps can vary greatly. Other teleconnections such as positive QBO, likely solar maximum and warm sea surface temperatures are providing slightly mild skew to forecasts. Europe's renewable output increased by 15% in 2024. Great Britain saw record-breaking renewable output in Q1 and 2, with renewables growing by 3.8% in the year to June 2024. This trend will continue into 2025 and will likely continue to keep spark and dark spreads negative, aside from some winter contracts. Wind output remains one of the main supply risk factors for the winter ahead, as lower wind scenario could boost more expensive fossil fuel generation, particularly in Europe. French nuclear output increased 29 terawatt-hours in 2024, after overcoming stress corrosion issues in recent years. Over winter, availability is expected to be 3 gigawatts higher year on year, averaging 48.4 gigawatts, the highest in 6 years. UK nuclear output will be hit by a flurry of planned maintenance outages over the next 2 months. Online capacity will sit at an average of 70% until mid-December, but will fall closer to just 50% in late November. With the shutting of the last coal-fired power station in the UK, gas-fired generation will remain a key baseload supply for GB. NBP gas and UK carbon for fossil fuel generators currently trade at a premium to their EU equivalents, and so GB gas-fired power plants are expected to remain at a price disadvantage to EU plants this winter. The NESO's recent winter outlook put GB base case margin at a comfortable 5.2 gigawatts, an increase of 0.8 gigawatts year on year, and the largest margin since 2019 to 2020. Interconnectors will continue to play an important role this winter, particularly during peak periods, and we expect GB will remain positive as a net importer over the season. The IFA interconnector will see a 50% of capacity offline in the last week of November for planned maintenance. LNG imports to Europe have declined 20% year on year. This was largely driven by lower gas demand, high gas storage levels, and higher Norwegian flows. European LNG arrivals will increase with winter demand, and we expect the US to remain Europe's key supplier, given current parity over US LNG netbacks for both Atlantic and Pacific basin destinations. Whilst non-LNG gas supply into Europe expected to remain steady over winter, conditions on global LNG market will continue to heavily influence prices. Rising Asian LNG demand is keeping Asian gas hub prices at a premium to European hubs. Weather is again a key risk here, as colder winters in Northeast Asia drive LNG demand. Some Asian market participants remain price sensitive, and consistently higher prices will result in some players withdrawing from the market. Global LNG supply is set to grow 6% in 2025, with North American projects accounting for over 80% of this growth.
The 20 MTPA Plaquemines facility received a commissioning cool-down cargo in August, with the first exports expected in Q4. The Corpus Christi 9.5 MTPA and LNG Canada's 14 MTPA projects are due to ramp up in the first half of 2025. Delays have impacted some projects, most notably the 15.6 MTPA Golden Pass project has been delayed by 6 months into Q1 26.
Geopolitical developments continue to support supply risk premiums and volatility this winter. Disruptions to shipping and the Strait of Hormuz and Israel gas production remain a key risk in this context. The Russia-Ukraine transit deal will end in Jan 25, and Russia is likely to increase flows via other routes, such as the Turk Stream, so the full 15 BCM loss may not be realised. Other options remain for flows to continue through Ukraine, including swap scenarios and spot capacity being offered on the Sudza by the Ukrainian system operator. Transshipments of Russian LNG in European ports will be banned from March 25. This could result in increased imports into Europe due to Russian tankers constraints by both Suez and the North Sea route to Asia. In the wider market, Brent oil has been highly volatile throughout the year. Over the summer period, the rolling front month contract shed around 20% and currently trades around $75 per barrel. Recently, price declines are linked to a weaker demand outlook, with OPEC and the IEA cutting its demand growth forecast for 2024 and 2025 for the third consecutive month, highlighting that any interruption to Iran's oil export could be absorbed because of levels of oil in storage that has reached to more than 1.2 billion barrels. and that the spare production capacity among OPEC Plus countries is at historic highs. Supply curbs by OPEC and its allies, including Russia, remain in place until December, when some members are scheduled to start unwinding their cuts. The fiscal stimulus announced by China has failed to give oil much support, indicating that it will not give enough to accelerate economic growth for the world's largest oil importer. Furthermore, strong US dollar has also curbed oil price recovery, which indicate interest rates may fall by a slower pace in the coming months. EUA carbon prices have been heavily correlated to TTF gas prices over summer, and we expect this pattern to continue. Increasing renewables and the lack of regulatory drivers could keep prices relatively stable, but the fuel switching dynamics present upside risk due to gas market volatility. In the UK, we expect new government's approach to net zero will support carbon prices into next year. Free allocations were marginally reduced in 2024 and 2025 recently, but the second period of the free allocation quotas could be pushed back to 2027 in preparation for the introduction of the UK Carbon Border Adjustment Mechanism. Weather will be a key price driver over the winter season. Not only will temperatures and wind output shape the supply-demand picture during winter, but these risk factors will feed into the storage picture as we reach spring and beyond. Given the unknown nature of both weather and geopolitics, significant further downside could be limited. Managing exposure to these risks is essential as we navigate through the next few months. And for customers on flexible contracts, increasing market risk means the risk-reward ratio for holding large open positions has narrowed. For this reason, customers may wish to consider increasing coverage, particularly for the remaining winter months and summer 25. For customers requiring fixed contracts, preparedness will be key to secure contracts quickly if we see known or unknown risk factors materializing. Therefore, we would encourage these customers to issue their tenders to the marketplace now to streamline the process of accessing prices for April renewals. And that brings us to a close on this update. If you have any questions, please feel free to contact us. You can also find our latest energy market commentary from our experts on the Trident Utilities website and social media platforms. Thank you for listening.